Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how are you doing this week?
Good. How are you?
Not bad. We're finally over the seasonal colds, it seems, for the most part in the family. So everybody's trying to get back to full strength.
From Virginia Beach this past weekend, and I was thinking like, man, it's gonna be great. Escape a little bit of the cold. It literally snowed last week, and the day I left, which is this past Friday, if you remember, it was like 72 degrees, sunny, beautiful.
So
And
nice.
I guess there's a big storm going through the Midwest and kind of the middle of the US. And of course it hit Virginia, and it was just rainy and cold the whole time on the way this weekend. But
That must have been was it a miserable run then, or not too bad?
it was not too bad. Yeah, that was like the one window that it didn't rain. So yeah, I did the half marathon that morning, that Sunday morning. But yeah, the wind and the rain really started to pick up right after it was done. So thankful it didn't kind of ruin the run. So
Yeah.
Yeah. All right. Well, guys, on this episode, we were planning to have a conversation about index universal life policies and if they're a good fit for what we call infinite banking or the family banking process and procedure. John, why don't you go ahead to kick us off? What is a IUL or Index Universal Life Policy, and how does it differ from our preferred method of using a whole life insurance policy?
yeah, of course. This is something I've gotten a lot of questions lately from people interested in infinite banking. And the question comes up, well, wait, why can't I just do infinite banking with an IUL or VUL, or why are you choosing whole life specifically over any other product? And that's a great question, and we're always happy to answer any questions that come up. So to explain the differences and to kind of give some context, so universal life is in and of itself a type of life insurance, right? What it involves is an annual renewing term life insurance component plus a side cash account, right? And this side cash account can be invested, truly invested, in whatever the type of policy it is. So there's IUL, which is indexed universal life, which means that side cash account is invested in an index such as S&P 500, whatever it may be. There's variable universal life, and in the financial industry space, variable typically is associated with the stock market, mutual funds, whatever it may be. So that's where it's the annual renewing term plus the cash account invested in stocks. And then they have some different flavors that maybe are a little more complex and I think even worse. But those are the two main flavors of universal life: is IUL and VUL. Very plainly, these are not good products for infinite banking. Nelson Nash on page 39, we have Become Your Own Banker here, very plainly says, I do not recommend the use of variable or universal life or IUL for infinite banking, right? And there's many reasons for that. One of the reasons is, and one of the draws to universal life is its flexibility. Right. So it's not this level fixed premium that you're expected to pay over a lifetime, right? It's actually incredibly flexible, where you can put in $20 month one, $2,000 month two, and it's all just based on what you choose to contribute. But what we find, and what Nelson Nash found, and what we're seeing play out, this is something that was built in the 1980s, is that these policies get worse and worse over time, whereas whole life gets better and better over time.
Right.
The risk remains with the policyholder rather than transferred to the life insurance company. So what ends up happening is that annual renewing term, we get older and older, which means we are more likely to die, it gets more expensive every single year. Whereas whole life is a fixed premium for the rest of your life, from which you can choose to do a lot of things from a position of strength and guarantees. So that's kind of at its core. Like whole life is this fixed, all-in-one type of bundle of life insurance and cash value accumulation, whereas universal life, honestly, if you think about it, it's kind of a buy term, invest the difference hybrid type of product
Right.
where they wanted to try to wrap it in life insurance when interest rates looked great during the 1980s. But those interest rates did not by any means stay in play, and it only got worse and worse. And so it is that term component plus a cash account. Um, it's just helpful to explain why it's not a good product for the infinite banking concept. You can try, I think. It would not be in any way as good as a whole life policy, but it's certainly definitely like an option for someone to want to try implementing infinite banking. But you are now taking on the majority of the risk and the losses that are going to come with it.
Yeah, I like what you said there. It's the buy term, invest the difference kind of hybrid. And I think we got a question. Why did Nelson, or how did he come up with or find that age 65 to 70 is kind of that range where these policies tend to blow up, or at least you're having to come out of pocket further to keep your policy in force? And that's the same thing with term insurance. I mean, how many 65 or 70-year-olds are you finding purchasing a term policy at that age in their life? It's just become too cost prohibitive for them to even entertain that idea. And so then they go without any life insurance. And, this is a personal story, and I've mentioned it before on the podcast of my own mother who, is in her upper 60s now, and her variable universal life policy is going to lapse because it's now imploded upon itself. The term costs have caught up to her, and now she doesn't feel like it's justifiable to continue to put money into this policy in order to have a small, very small death benefit because of it. And I think that's exactly what we have come to find out. As you said, John, these were created in the 1980s. So if you were a 25-year-old entering the workforce, we have now just gone through one generation of workers and who are now reaching that 65 to 70-year-old range, and these policies are collapsing upon themselves. And so it doesn't work for IBC in particular. And it really doesn't work if you ever foresee yourself taking retirement income from these types of policies. It's the added cost of the renewing term once you hit that retirement or passive income age. It's really going to be difficult to try to take money out of these policies in order to finance or pay for your retirement or living expenses at that point in time. But Rob, I'll turn it over to you. What are some of your thoughts about IULs or universal life policies?
Yeah, one of the things that I really appreciate about whole life is the simplicity of it. If you just look at a whole life contract, basically you pay your premium and you're good. That's all of the risk has been transferred over to the insurance company. Where these in universal life contracts, index universal life contracts, variable universal life contracts. If you just want to like look at the number of pages in a contract to compare the simplicity, a whole life contract, 18, and like a index universal life is like 48 pages. Like that tells you something right there, that there's a massive difference in the contract. And we were just talking to some folks last week at the think tank, and this was enlightening to me that in those contracts, the insurance company can literally change the rules. It's in the contract. If they are losing money on this contract that you signed with them, they can change the rules so that they don't lose money and that you lose money, so that they protect themselves. So I think that's just like a wake up call to folks that it might seem attractive, but all of the risk, or not all of it, but more of the risk is transferred to the client with variable products, or not variable, universal life products, than with standard straight up whole life. And I just love how simple and straightforward the contracts are with whole life. And it's just a good reminder to be careful about what you're getting into. And then the idea too that it's all based on a renewable term chassis. And so when you see that, and I've looked at many term policies, and when you run them through the illustration software, it's eye-opening. You have a 20-year term, year 21 just exponentially shoots up in cost. So that really tells you that's the cost, that's the actual cost of to the insurance company. And so that's what's happening underneath when you have a universal policy, is that annual renewing terms higher and higher and higher every year. When you hit that 65, 70, it really starts to get expensive. And now we're seeing, after, like you said, since the 80s, we're seeing these policies implode and consume themselves because the costs are getting so great that there's no cash value to sustain them anymore, and they just have to be dropped. So it's just a word of warning for folks who are considering it.
Yeah, let me try to give an example of what you're trying to say there. The how an insurance company can manipulate and change the way an IUL policy performs, or any type of universal life policy performs. Oftentimes consumers think that, oh, it's I've got stock market exposure, which is great. If the market goes up, my accounts go up as well. But if the market goes down, there's a 0% floor, meaning that I'm not losing money that year, right? And so that's kind of how IULs are spinned. The problem is, well, if the life insurance company can change where the floor and where the ceiling is set, if all of a sudden now they'll allow the policy to maybe only get a minus 2%, but the ceiling is now also dropped down to 8%. So they've shortened the window and the amounts of returns both up and down. But the important thing is they can move the target whenever, wherever they want. And you're none the wiser, and you don't have any recourse to go back to the insurance company. There's nothing you can really do about it. And that's what Rob is saying, is they have transferred that risk onto you as the purchaser, the consumer of their product. Whereas with whole life insurance, it's written into the contract. You know upfront what you're getting into, and there is no moving the targets. It's set in stone, if you will, and based upon the profitability of the insurance company as well. That's how they're generating those dividends. But the performance otherwise of a whole life policy is going to be much more stable and secure compared to the IULs, where they can move the numbers and kind of fudge it however they want.
Yeah. And, Tom Hegna is an expert in the retirement income space, and really, really smart guy. And he'll say something to the effect of, the only life insurance policy that matters is the one that's in force on the day that you die. No other life insurance policy really matters at that point. And generally, these IULs and VULs are not going to matter, because they're not going to be in place when most people are most likely to die in their later 65 plus years. Not to mention all the living benefits that you are most likely not participating in, because you're losing guarantees when you're accessing these funds, because you're only able to access a smaller amount compared to the overall cash account, because it is a volatile, fund, and so forth. So, like, having this policy, a whole life policy that's guaranteed to be there on your last day, and all you have to do is just pay this fixed premium for the rest of the life of the policy. You could even choose to do premium offset from dividends, and you have tons of flexibility long term. And that's what the IBC is. It's a long-term play. It's not trying to just chase a rate of return for 2 to 3 years. This long-term play, like, really lends itself to whole life that we know is going to be in place when on the day that we die, right? And it's just it is tragic for me to think that someone's going to have paid for 20, 30, 40 years into a universal life policy and not receive the death, like their heirs not receive the death benefit. And basically all of it collapse on itself. That is just tragic. So we're thinking generationally. We're thinking as this family banking system from which your grandchildren and their grandchildren are going to benefit from. Universal life is not going to do that. In fact, is only going to impose most likely a financial burden or hardship or stress rather than giving the peace of mind and the simplicity, like Rob, you're saying, that whole life does.
One of the things that I'm always interested in is trying to follow the quote unquote smart money. And that, in my opinion, the smart money is the banks, right? They control the money and they have all the money. And so what are they doing with their money? Their banks are purchasing a lot of whole life insurance on their employees, their executives. Why is it that they are not willing to take the risk and purchase IUL policies on those executives? Well, it's because I think they know the numbers, the behind the scenes, if you will, and they want the guarantees that you're talking about, John, that these policies are going to pay out with 100% certainty, not contingent upon stock market risk and volatility there. And so, yeah, that would be my advice to our listeners. Follow the smart money. Do what the smart money people are doing, and that's buying a whole life policy. And if you structure it properly, if you're working with us, of course, you're going to get the advantages of having that cash value component early on in the policy and being able to finance the things of life that you need or to begin investing in other opportunities as they may present themselves. And so that's the advantage of not just whole life insurance, but the particular way that we as infinite banking practitioners design these policies for our clients. All right, guys, any other final takeaways or final thoughts here before we end today's episode?
I think it's a really simple topic, especially based on how Nelson talks about it in the book. It is simply like we won't write for anyone who desires one after all the considerations, right? I don't personally know anyone that I trust in this space who also would write one. So it's like, you want to find an IUL, we are not your guys. We can't even connect you to a person to write it because I don't think there's anybody in our circle who would do that either. So it's a very simple way that we're approaching it, and I think it's based on all the guarantees and benefit for the policyholder.
I'll echo John's statement. That's keep it simple. Keep the guarantees. And the more we do this, the more I appreciate the simplicity and the guarantees that you get with whole life insurance. When I was younger, I was trying to figure out how to beat the market, and the market kept beating me. And when I was exposed to the infinite banking concept through Nelson's book, that's when the scales fell off, and I was like, "This is what I've been." So what I didn't know I was looking for the whole time was the security, the guarantees, the really good uninterrupted compound growth, the protection of my family. I can leverage it for emergencies and opportunities. It's like, I just wish I would have known about this 20 years ago. So yeah, and that's what I love about it. It's just, you just pay premium. It's a contract. You pay your premium. The insurance company honors the contract. That's all there is to it. And then the one aspect that we can help with is that we help to design it in such a way that you can leverage that early cash value from the beginning. So then it's a win-win-win. So it's such an amazing product and an amazing process. Keep it simple, people.
Well, as we are coming up on a year's worth of content, we have a favor to ask our listeners. If you've been enjoying our show and our content, or if you're new to the show, if you would please consider subscribing, liking, sharing, doing all the things that you need to do in order to help us beat the algorithm. And really what we're after is trying to help more and more people, get more and more people involved with the infinite banking process and start their own family banking system for generations to come. And so with that, guys, thank you again for your time, and we will see you in the next episode.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.